What is your current assessment of the global economy and financial markets?
Well, Adam, I think what's going to happen here is there's a few things getting ready to fall that hadn't fallen before, which were earnings. And I think that's going to have a major impact. I think people are not factoring in the weakness that's coming from these companies earnings wise. And I think that's going to have to be priced in at some point in time. So we look for the market to go to new lows. I don't know what that number is necessarily, but it's certainly not, I don't think it's where it is now. All year long, we've had this obsession with trying to catch the low in the market and the high in the rates so we could front run everybody. But they don't work that way. That's not the way things really shake out in the long run in a bear market. We'll see how it plays out. But for us right now, we just think that's where we're headed over the next few quarters.
Sounds like you think the bear is just sitting on the side right now, sharpening his claws, coming back, and will bring the market to new lows at some point in 2023.
I do. One of the things I've noticed is that by and large, investors haven't gotten scared enough. It's interesting to us. They've lost money. I don't know if they've been talked into it by Wall Street that, hey, everything's okay, so just stay with everything, or what it is. But typically, you'll have to get enough damage in those portfolios to where they finally say, hey, look, I'm out. I'm at least out a part of it. And that we haven't seen that yet. It's been an interesting turn for us this year.
You did say that you think 2023 will likely see, or maybe we've already even seen, the peak for both interest rates and CPI. And on the day you and I are talking here, they just released the December CPI numbers, which are showing that we do seem to be now in a pretty identifiable disinflationary trend. Is that truly the case? You think we've seen a peak in both?
What we were referring to on rates was not the short-term rates, not less 2 years and less, but the long-term rate really. Because if you look back, the long-term rates, I'm talking about 20 to 30, they peaked a while back, and they've come off since then. Not to say they couldn't go back, but we don't think they will. And we're talking about long-term rates when I say that we think the rates have peaked. And we think, inflation, I don't know, was 9 points back in June, July. And obviously that's rolled over. But people have to remember that all of that takes place while the economy is tanking.
Right.
So as you go lower and those numbers get worse, then that means you're headed more and more into a recession. I think that's what they've failed to understand on all of this. And for us, we just think that perhaps they're getting this wrong, and that maybe this time Jay Powell is in a mode where he's saying, hey, look, I wanted to get rid of this thing where the Federal Reserve is always the one driving the bus here. And so we don't want to just run liquidity in and support the stock market. Maybe wrong on that, but he seems to be going that direction. If in fact that's the case, the long-term rates can stay there or come down, and you can have CPI coming down as well. I do disagree with people that think that the short-term rates are based on the bonds, because if you want to see those 2-year rates keep going up, watch him just keep raising those rates, and the bonds won't go against that. They'll buy their treasury. So we'll see how the plan pans out, but we're talking about, that's what we're looking at right now on top of that.
You're saying, and correct these words if they're wrong, yes, that may play out a bit over maybe Q1, half one of this year, rates going a bit higher still from here, but in the short term, but you don't really necessarily see a clear trigger for why long-term rates should rise back up to the highs they were at, a few months back.
Well, it doesn't look like it. It looks like the inversion of that curve is just going to get larger, where you might even go to 1% or something, where the short rates are 1% higher than the long. It could very well be that way. I don't think people need to understand that if you look at the Fed funds rate, I don't think they stop that until that at least squares up with inflation. So it's 4.5 right now. Inflation 6.1, whatever it was today, still out of balance right now. So either one comes down a lot or the other one goes up more than they think. We'll have to see.
Sounds like you think Powell is going to do what's necessary policy-wise until he really has confidence that inflation is stamped out.
What happened during that period is right in the middle of the 70s, when you got that 73, when you got that big push on inflation. And of course, they raised the rates, it busted things back into the 73, 74 recession. It was a bad recession, so they came again with it, loosened up too much. They didn't let it, ferret itself out. And so what that did, but then that pushed it to a new high. Arthur Burns is out, Paul Volcker's in, and then he has to really bite the bullet. And I'm thinking that Jay Powell's trying not to have to get into that situation.
is if something were to force a pivot, let's say something really bad broke and it just bad enough that it forced Powell to really have to reverse policy sooner than he wanted to. I don't think that's going to be a bullish moment for stocks. That's going to be a crisis in the markets, right?
You're exactly right. I think people that don't know a lot of history about the markets don't understand this, but when they start lowering, that means they're fearful of things that are already happening badly. And then the markets react just like you're saying, they react poorly. See, all of that's ahead. We haven't even stopped going up yet. And that means we haven't flattened out yet. And we certainly haven't started going down. So I have no idea why Wall Street is so consumed with this. I mean, they're consumed daily with it. And I think they've really gotten it all wrong.
You said that the economic news you believe is only going to degrade as we go further into the first half of the year here. One of the things that you mentioned, we'll put up this chart here, the ISM purchasing managers charts have gone into negative territory, which shows that we're now in contraction in the manufacturing space in terms of spending. But is all this true that you just sort of consider, you look ahead and just see this continued sort of just grinding down of growth and opportunity in the economy?
Well, I think so. And actually, just since we put that out, the services came out, ISI services came out well, and they went into negative territory. And I think most people don't realize that this wholesale drives the market, not so much retail. If you look at what drives the market, typically in the ISM, it's wholesale. And what that tells you is that the people that are producing, manufacturing, et cetera, they're saying, hey, business is slower, we're not buying as much, so that's where we're headed. My guess is at some time in the first 1 to 3 quarters that you start to really see that take effect.
What's your forecast for layoffs, right? As companies get increasingly squeezed, the economy contracts further from here. Are you concerned that we could see wide-scale layoffs that sort we've seen in past substantial recessions?
Adam, that's probably one of the hardest things to figure this time, because we dropped a lot of people out of the group. And I do think they're going to have layoffs. I mean, it's going to continue and it's going to get tougher. The thing about it is, and I know if you look at most small businesses and the good employees they have, they will ride with those longer than normal because they know they can't rehire somebody as good as that person. I'm involved in 3 or 4 businesses, and the thing about them is you try to keep your good people, even if it costs you more money than you normally would spend. And so that's a really hard thing, though, to figure. It's hard to figure out actually how many of those would do that. We think a number would. Unemployment will go up. I think unemployment has to go up, or he keeps the pedal to the metal here. I think that's one of the things he looks at.
Sounds like you are maintaining that defensive posture coming into 2023 here. You mentioned that last year, the commodity side of your portfolio did quite well, specifically natural gas, oil, and gold. I think you've kept on the natural gas and the gold, but you've sold off some of your oil position, I think. Can you just very briefly explain why?
What we sold was the big oils. If you look at Devon or Chevron, those kinds of things. What we kept were oil royalties. If you look at what we kept, CTO, Permian Basin, those kinds of things, Texas Pacific. If you own the oil royalty and you're wrong on the oil, you'll still be right on the royalty, you see. And we get better cash flow on the royalties than we get on the big oil. And we really felt like oil was coming down, and it has come down, but we're still getting good payments on the royalty side.